I was asked this morning on TV what X factors could happen this year. Of course, no one can predict X factors. That's why they're X factors. Nobody knows they're going to happen. But let's have a guess at some of the potential X factors for the next 6 months. My focus at the moment is getting a good return by the end of the year. It sort of moves 6 months every time. So I'm really focused on what's going to happen in the next 6 months. What are we going to look like at the end of the year? What X factors could affect our current assumptions, which is we're in a bull market again and everything's going to behave. Things that might not happen as we expect are, here's one, no Trump. If you look up the actuary's report on Trump, he's 78, he's overweight, he eats fast food, and that is offset by having some of the best medical attention, if not the best medical attention in the world. The actuaries are giving him a 78% chance, as a 78-year-old, a 78% chance of living through the whole of his presidency. So what would happen if Trump disappeared? If we were April the 7th, when the market was collapsing on tariff fears and recession fears, the market would pop 40%. But from that very low point, the S&P 500 is actually up, can you believe it, 40.6% already. So if Trump disappeared, we would have seen a rally on the back of the tariff issue hopefully disappearing. What would happen now? I don't know. I think if anything, it would shock the world. We'd probably see a bit of a market correction, which would be a buying opportunity. The big macro backdrop, which is interest rates and inflation, is behaving itself at the moment. And that again is another X factor. What happens if something unexpected happens on the inflation front? Say they block the Straits of Hormuz, and there is another outbreak of hostility in the Middle East and the oil price shoots up. That could change inflation thinking. So that's another X factor, geopolitical risk and a return of inflation. That could happen in the next 6 months. Another one I think would be AI optimism disappearing. And we've got the assumption at the moment that AI is back on track and we've completely forgotten about DeepSeek, but maybe something would come along and deflate the AI bubble again, whatever that could be. Can't see that it's going to happen at this point, but maybe another DeepSeek moment where everybody realizes suddenly big tech is not going to own AI. It will become a commodity and the earnings will spread amongst many corporates, not a few. That's another possibility. On the positive side, X factors, I think new themes, what could come up that we haven't invested in that could become a fabulous opportunity. One of the obvious ones was in the NVIDIA shareholders meeting. It was one line, 1% of their revenue, 1% comes from robotics and automotive, which is self-driving cars. The NVIDIA CEO was talking about having to build a cloud to back robotics. If we're going to have 1 billion humanoids walking around, there are going to be 1 million investment opportunities if we've got 1 billion humanoids walking around the earth by 2050. But that building a cloud for robotics could be one. They need a cloud. And it's being used by AI at the moment. They have to build another one. So that could be fabulous for semiconductor stocks. And building cloud for self-driving cars, that is going to just need endless cloud computing power. So new themes, robotics, self-driving cars. If you look at the exchange-traded funds that performed well last year, incredibly, it's always something a little bit out of the blue, but incredibly the best performers were two, GAME, G-A-M-E, and video, which is video games. And we never even wrote a line about it last year. We missed that. One of the weird ETFs that has regularly been one of the best performers over certain periods, whether it was last year or not, crypto was in the top. A couple of years ago, it was the top ETF. You know, our game is to make money out of any price movements over any time periods. If crypto's it, crypto's it. We don't have to argue its integrity. We just have to take advantage of its share price, of its price movements. If the world fell over, also gold, also that would help crypto. Crypto's seen as a little bit like gold, scarcity value, and a flight to safety would push gold and things like crypto. What else? Maybe the Asian markets will lift. There are plenty of Asian tech ETFs, and also I think uranium's on the move now, and maybe atom, URNM, two ETFs you could look at. So other themes developing, other X factors. For Australia, X factors might include CBA's legs finally being taken away. It's up 45% in a year. It's overvalued. Money's squashed into it. I think the only time the CBA and the other banks will fall over is if there's significant market correction, and that's what will undermine them. Probably nothing specific for the banks. The other issue that could happen is some sort of recurrence of that bond market, global financial crisis threatening. Worries about US debt and the ability of the US bond market to finance that debt. That is the big one, and we wouldn't want to see that come back, but that again is another X factor. Anyway, for the moment, you don't do anything about them until they start to happen. So for the moment, the best assumption is current assumptions. Current assumptions are we're back in a bull market. Big tech is better than any other sector, and the US is far more interesting than Australia. Hi, Marcus here. I'm doing a webinar on July the 16th. You can sign up below, apparently. And it is going to be about property and shares, or rather property or shares, because I have a number of kids in their 20s who are thinking about buying properties. So are a lot of their friends. And is that the right thing for them to be doing? Or would they be better looking at something else to invest in? And shares are the obvious alternative. So I'm going to address that issue. If you've got kids who are wondering whether to buy a property at the moment, or even kids who have just bought a property, and you are talking to them about whether to do that, this webinar might help you. Anyway, sign up below.